Welcome to The Explainer. Today, we're unpacking a really dense, rapid-fire portfolio breakdown from Durrett, and it's focused entirely on precious metals equities. If you're looking to actually understand the mechanics of the mining sector and how specific companies are positioning themselves for what the source describes as a true precious metal supercycle, well, you're absolutely in the right place. We're going to take a massive list of companies and distill it down into a clear, structured view of the industry. So let's get right into the mechanics of this portfolio. Right off the bat, to understand literally any of the valuations we're about to look at, we have to start here. This entire portfolio strategy is anchored on a very aggressive pricing model. We're talking $7,000 gold and a whopping $200 silver. Every single projection, target, and risk assessment in the source material is built directly on the assumption that these metals are heading to these historic highs.
Okay, let's dive into this. Throughout this explainer, you're going to hear the term bagger tossed around. So if a stock is a 10-bagger, it means its price has grown to 10 times your initial purchase price. Under the source's $200 silver framework, they are projecting anywhere from 15 to 50 baggers across this list. I mean, it is an extreme revaluation model, and we're going to look at the exact companies they genuinely believe could achieve this.
Just to give you a bit of context on how this whole portfolio is structured, the source actually holds around 169 different positions. But for this explainer, we're focusing on a very specific slice, roughly 50 elite stocks. Even though they only make up about a third of the total positions, these represent the absolute highest allocations. Basically, these are the companies where the source point-blank refuses to be underweight.
All right, here's our agenda. 1. The $200 silver thesis. 2. Emerging junior producers. 3. High-potential greenfield developers. 4. Discounted major miners. And 5. Assessing risk and reward.
Section 1. The $200 silver thesis, anchoring the supercycle. Let's look at the underlying thesis that makes these specific equities so incredibly leveraged to precious metals pricing.
Why this matters is perfectly captured in this quote straight from the source material. You see, the driver behind that super bullish $200 silver valuation isn't just wild speculation. It's based on a projected structural deficit between solar panel manufacturing and heavy, everyday industrial demand eating into the global supply. Simply finding and securing large-scale, permitted deposits, it's becoming the single most critical bottleneck for the entire industry.
Section 2. Emerging junior producers, the foundation of growth. That brings us right to our first tier of the portfolio, which really forms the foundation of these early-stage growth strategies.
Let's break down this junior tier objectively. It's kind of like a giant puzzle. Some are chasing aggressive expansion, like 1911 Gold needing a second deposit to hit their 75,000-ounce target. Others just have massive hidden value. Take Andean Silver. Their market cap essentially only reflects their current Zagounder mine, which totally leaves their much larger Boumediene project as unpriced upside. Meanwhile, you've got deeply discounted players like America's Gold and Silver, alongside companies like Andean Silver, who are targeting a restart with low CapEx, meaning super low upfront capital expenses, to pull 5 million ounces a year.
Now, what's really interesting about this slide is the stark contrast in how these juniors actually plan to grow. On one side, you have Avino Silver expanding organically by about 1 million ounces a year with absolutely zero shareholder dilution. But on the flip side, you have Blue Axion trying to scale up without owning a permanent mill. That means they have to rely on toll milling, which is essentially paying a third party to process their ore. As you can imagine, that is a massive operational hurdle to clear when you're trying to scale.
Section 3. High-potential greenfield developers, the supply pipeline. This is the tier the source believes presents the absolute highest potential revaluation opportunities. So these developers hold massive untapped reserves, but man, they require immense patience. Just look at Discovery Silver, sitting on the Cordero project. It's a staggering 1 billion ounce deposit. Then there's Chesapeake Gold holding 15 million ounces of gold, but investors are just stuck waiting on a pre-feasibility study, which is a really lengthy early-stage economic assessment. Meanwhile, Denarius Metals is out there actively building a 5,000-ton-per-day mill in Colombia for Q3, and GoGold Resources is busy securing permits for Los Ricos North using their own internal cash flow. So yeah, huge potential, but a very long pipeline.
I really want to emphasize this super bold claim straight from the source. They state that once these specific massive developer projects are built, there's going to be nothing left. No more big silver projects. It perfectly illustrates the extreme scarcity of large-scale silver deposits remaining globally, and that of course fuels that $200 silver thesis we talked about earlier.
And this brilliantly illustrates what happens when one of these developers actually hits their target. Let's look at BMC Minerals up in the Canadian Yukon. Their target output is a jaw-dropping 32 million silver equivalent ounces annually from a massive polymetallic deposit. By the way, polymetallic just means it holds a mix of multiple valuable metals, not just silver. At a current $500 million market cap, the potential free cash flow here, once they're fully operational, is absolutely massive.
Section 4. Discounted major miners. Leverage at the top. This is where you find established industry giants that are currently trading at historic valuation discounts.
When we look objectively at these majors, we're seeing high-volume producers taking massive market beatings. And that creates these incredible setups where the potential upside massively outweighs the downside if you've got patient capital. Kerr Mining hit what the source calls a cyclical floor around $14.30. First Majestic is deeply discounted as they restart their JC mine. Fresnillo has incredible established infrastructure but is sitting at a really beaten-down $32 valuation. And B2 Gold offers a great dividend, though as we'll see in a second, that does come with some distinct geographic risks.
Let's pivot to Equinox Gold and see how this builds into an aggressive growth story, even at the major tier, through aggressive debt reduction, lowering their overall operational costs, and strategic consolidation, specifically with the pending September Aura deal. Equinox is pushing hard from their current baseline toward a near-term target of 1.5 million ounces, and their stretch target reaching nearly 1.9 million ounces annually.
Now here is a pretty wild fact for you. Despite being massive, established, household names in the mining industry, both First Majestic and Fresnillo mathematically print as 8-baggers under the source's $200 silver framework. Finding that kind of leverage at the very top of the food chain is rare, and it's a huge reason why they command such heavy allocations in this portfolio.
Section 5. Assessing Risk and Reward, the reality check. We've talked a lot about the massive upside, but now we really need to ground this explainer and objectively assess the structural risks.
Because the crucial reality here is that absolutely none of this is guaranteed. Take B2 Gold, right? They produce 1 million ounces, but half of their projects are located in Mali, exposing investors to severe West African geopolitical risk. Then you've got BMC Minerals. They have their environmental permit, sure, but they face an impending appeal from a native group in the Yukon. And for Chesapeake Gold, the risk is simply time. They're facing long-term delays as investors literally just wait on a single pre-feasibility study.
And this right here perfectly summarizes the core tension found throughout the source material, the developer's dilemma. The ultimate leverage in a precious metals supercycle is buying cheap developers. The reward? Immense free cash flow upon completion. But the risk is navigating years of heavy capital expenditure, brutal permitting appeals, and severe shareholder dilution. I mean, if a company has to constantly issue more stock just to survive, your slice of the pie shrinks before they even make it to actual production.
Which brings us to our final thought for today. The source builds this entire portfolio on the idea of a structural deficit and extreme scarcity. So if the era of discovering massive billion-ounce silver deposits is truly ending, which tier of this portfolio, the nimble juniors, the waiting greenfield developers, or the discounted majors, actually holds the key to supplying the next decade of industrial demand? Thanks so much for joining us on this deep dive, and we'll see you on the next explainer.